I'm just going to go over the usual housekeeping rules. Please mute your microphones unless you are looking to speak. If you wish to speak, either put it in the chat box or raise your hand. Those of you that are on iPad, if you go into what looks like a hamburger menu and click on that, that should bring up your hand, and you should be able to raise your hand, which will show in a little box on your screen for me. We will be asking the guys to answer your questions throughout the presentation, so don't be afraid to put your hand up and ask. But once you've asked your question, if you can then mute your microphone again, because I have to say it's extremely distracting when I've got someone rustling a bag of crisps in the background, or I can hear somebody else pouring a glass of wine and I want one. So that would be great. Obviously, just to make sure where we're not expected to have a fire alarm this evening, so should the fire alarm go off, please use your most closest exit. Thank you. So now we've got all that out of the way, what I'll do is just explain for those that haven't been along to one of my meetings before. We're now in the 9th year of Hemel St Albans Property Network, so we have been going quite a long time. Hello Stella waving at me, and I'm going to continue these as long as I can, obviously, and have some great speakers like I've got along this evening. All of the events are recorded, and once they are recorded, they go on our YouTube channel, which is very simply Hemel Property TV. It's as simple as that on YouTube. So you can, anything that you've missed, or if you know somebody that you think might benefit from this, then please direct them to the YouTube channel and they can download all the previous meetings from there as well. So the way this meeting works is I just do this housekeeping bit. I'm going to very quickly go over the legal update, because obviously with COVID it's kind of changing on a daily basis. And then that's it, that's my job done, and I hand over to the guys for you for this evening. They will run through their presentations and I will just keep going up and down the screen to make sure everyone has their microphones off. Any rustling, and I will be muting you. So obviously you all know why you're here this evening, and it's for advanced tax strategies for property professionals to create a tax-free income. So let's hope you're all here for that and nobody's here to see me, I don't know, knitting or crocheting or something. So I'm just going to go in now to the legal update. Now, obviously, not a lot has changed, in all honesty. We are still in COVID. We still know that we can't evict tenants at the moment. But as you may have heard, the most recent update is the fact that the ban on evictions has been extended to the 23rd of August. Now, what does that mean for you guys? So it means you can still serve notice. Please don't think you can't serve notice. You can. But it has to be 3 months notice, whether that's a Section 21 or whether that's a Section 8. Now, normally with a Section 8, you have different time limits. You can have 2 weeks, you can have 4 weeks, you can have 2 months. All of those notices now must be 3 months, including a Section 21, which is normally 2 months. Once that expires, you can still put your application into court. So what I've heard a lot of landlords misunderstanding is if they've served a notice prior to the 26th of March when these legislations came in, and what has happened is their Section 21 or their Section 8 has expired during lockdown, they don't think they can then put the application into court. You can and you must. Very simply because a Section 21 since 2015 has a 6-month shelf life. So once you have served it, you only have 6 months to activate the possession proceedings. So you can stop the clock once your Section 21 has expired by putting your application into court. That stops the clock on the 6-month shelf life. So just to make that clear, you can still serve notice. It must be 3 months, but once your notice is expired, please get that application into court. What will then happen is your application will just sit in the administration process in a box, and then once the courts reopen on the 24th of August, the processes will start. At the moment, there's about 30 to 35,000 applications sitting in a box waiting to be administered. So if you are expecting an eviction in 2020, I don't think it'll happen. I spoke just at the weekend with Paul Champlina of Landlord Action, and he has confirmed to me the same. He does not think anybody will be seeing evictions in 2020 unless your application was already in the court process before the lockdown, and basically all someone is doing is taking it out of the box, having a quick whiz over it and stamping it as an eviction notice. So just be really mindful of timelines when you're serving notice, and maybe serving notice isn't necessarily the best option. Lots of communication with tenants should be happening now, and obviously you've got the PRS, which is the Property Redress Scheme, have just launched their new mediation service for landlords. You don't need to be a member of the Property Redress Scheme, but they are there to help you mediate, and they are a hell of a lot cheaper than a solicitor, and any documents that they draw up, so repayment plans, that sort of thing, is all legally binding. So if a tenant then defaults, you can go to court with that document and say, well, look, we had mediation and everything, and they still defaulted. Just going on from that, there is currently legislation going through Parliament at the moment. We're waiting for it to be signed off, and that's a pre-action protocol for landlords. So at the moment, social landlords since 2017, if I remember correctly, have had a pre-action protocol for rent arrears. They've had to follow certain procedures before they can even serve notice. That is coming in for the private sector. So landlords will need to have a certain process that they follow before they can even serve a Section 8 or a Section 21 notice. It's likely that it's going to follow exactly the same procedure as the social housing. So that's going to be a case of you talking to your tenants, finding out if they're entitled to benefits, helping them in line with applying for those benefits, pointing them in the right direction, signposting. Mediation is going to be part of this protocol. So if you already have that in your process, then you've already ticked a box, but it's something you're going to have to start thinking about moving forward. And obviously, like I do with any legislation, as it moves through Parliament, the more I know, I will obviously let you guys know. And as soon as it becomes law and gets royal assent, then obviously I'll publish the article on it and bring you all up to speed. So that's that for now. Has anybody got any questions for me before I hand over to the guys for this evening on the evictions and notice periods and anything like that? No? Okay, well, if anyone does have any questions, pop them in the chat box or contact me. You've all got my contact details, so just let me know if there's any problems. And I am now going to hand over. Which one of you is going to be first, Huggy or Darren? Darren. I'm now going to hand over to Darren. So unless you want to speak, please keep your microphones muted. Thank you very much. Darren, over to you.
Thank you. Julie, if anyone does raise a hand, could you let me know, because I can't see everybody.
Yeah,
I've got some
absolutely.
prompts on my screen, so that would help. Hello, everyone, and thank you for Julie for giving us the opportunity tonight. For those that don't recognise me from previous meetings, I'm a financial advisor with St James Place Wealth Management, and tonight myself and Huggy Clark, who's from the Foresight Group, are going to be talking to you about advanced tax strategies. We're going to be focused on a couple of tools. One of them is pensions, and the other is a venture capital trust, or a VCT for short. We're going to look at ways in which they can be used to enhance your property investment strategy. As I said, Huggy's from the Foresight Group, which is a VCT provider with St James Place, and that's his specialist area. So I'm going to leave that for him to talk to you about. But we've probably been working for about 18 months together now, me and Huggy. And generally, Huggy comes in, he'll talk to me about an idea, and I'll just sit there kind of like a bit bemused, like, can you do that? And so, yeah, he really knows his stuff. And he's probably one of the two people that's kind of blown my socks off with knowledge and how we can use these structures. Yeah, so a bit of background about myself. I've actually been in property investment for a long time. I think my first flat I bought over 15 years ago. I've done it up, I sold it on. I've currently got buy-to-lets, and my family's always ingrained in me that property is a great investment. So even when I've sort of learned to become a financial advisor, it's very much through a property investor's eyes. So again, I've probably experienced much of the changes like yourselves, changes to mortgage interest, stamp duty, considerations of SPVs and incorporation. So yeah, I've kind of been through your guys' journey as well. And if some of you come to the session a couple of weeks ago with 118 property, there's a case study at the end where we use some of the techniques that they talked about. So I'll go through that later on. One thing I must highlight is we're not actually giving financial advice, we're just outlining the concepts. If anyone does want to talk more in detail, then we can do that offline, and that would need sort of more information on your personal circumstances. So I started property networking, I think it was back in January, and there was two reasons. One was I was having a problem with a tenant, which Julie and the guys helped me with. And in fact, your update today is just give me a bit more insight. I've actually issued a Section 21 before we started lockdown, so I'll probably follow up with you on that, Julie. But the second reason was really to understand the mindset of property investors and property developers and see what techniques people are using, and more importantly, not using. And along the way, I've come across different ways, SPVs, creating group structures, loaning in between, developing and pulling equity out and buying others. And I'm sure you guys would probably teach me a lot more. But what I learned along the way is whatever we do, at the end of the day, tax is tax, and it seems to always be a limiting factor. Now, if your property is in your personal name, then the changes recently have impacted hard. If you're investing within a company, it's great. You're probably as tax efficient you could be, but we still have the problem that when you want to take your money, you're still getting a second wave of tax on that. So in general, we kind of get to a situation like most business owners is how do we take our money, or how do we extract the profits efficiently that we can still help our end goal. And I started to think, which investments can we use from my side as a financial advisor, firstly to reduce our tax, be that year on year or when we're disinvesting, and then how can we use these investments to grow and invest in property, or to create a tax-free income, and that's why we're talking about pensions and VCTs. Some of the examples we probably use may seem a bit far-fetched, and everyone's situation is different, but the numbers in there are just to emphasise the concepts that we're talking about. So I think what I did is I had a good look, and I realised, if I said to each of you individually, if I could give you the ability to write yourself an expense or an invoice that goes against your business expenses, say I'll give you £40,000 a year, we're going to reduce your profit and you're still able to keep that money personally, then I'm sure many of you would agree that would be a great idea. Let's have a look at the circumstances. In some cases that could be, let's write you an expense to yourself for £160,000 for the year. Let's look at wiping out that tax. Now, if I said, let's take that money that we've taken and let's use that to purchase property, and then what we'll do is we'll give you a tax-free income off that, and we won't make you suffer capital gains tax, and we'll put it outside of your estate, so you won't pay any inheritance tax on that. Now it starts becoming a lot more attractive. And then if I said, well, let's do it in a way that at the end of this we can get our money back and then we can reinvest it somewhere else, and you're still getting tax-free income, you're still getting no capital gains tax, you're still no inheritance tax to pay. I'm sure again it's starting to look like an attractive offer, but all this is the modern day pension, and I can't emphasize enough how good of an investment pensions have become since the reforms. The government doesn't want us to keep buying property, and so it's changed the rules. But what it does want us to do is save for our own retirement. The state pension is not going to meet demand in the future. So they've again shifted the rules, so it's massively in our favour. Anyone who's not not contributing to a pension through a company can do it personally. The rules are different, but the government again is going to give you 20% as a minimum on top, and this can be then used to tailor how much tax you pay. It's a good way to keep yourself in the basic rate tax band, or if you're coming from additional back down to higher. It's also a very good way if you're looking to get into investing. Now, existing pensions can be a great way to either purchase or pay off mortgages quite quickly. We can recycle contributions. Just an example of that, and this does relate to commercial property. So if you used to purchase a £200,000 commercial property and you had, say, £100,000 in your pension, what we could do is purchase half of the property with the pension money, and the money comes back into the business. So all we do is then use the money that's come back in to refund your pension, and then buy the second half. And so what you end up with is a £200,000 property in your pension, £100,000 in your business, which can either be put back into your pension, or you go again, you look at other properties. And again, the same rules apply. The rental income is tax-free. That can be invested. So again, it starts becoming even more efficient. You're getting growth on the money that's coming in from the rental income. So that, as an outline, is why pensions are a very good investment, or a good way to supplement and work alongside property and all the investments you've got. What I'm going to do is pass you over to Huggy, and he's going to go through the VCT structure. And then when we come back at the end, I'm just going to go through a case study just to try and bring it to life a bit more on some of the things we've been doing.
Okay, just before we pass over to Huggy, I have had a question come through on the chat. Darren,
Yep.
Can you share a couple of worked examples in document form?
Yeah, well, just email them across after, you mean?
I don't know. Melinda, do you want to unmute yourself and see if we've got this right?
Yeah, it was just to sort of see a couple of examples. You've gone through it in words, but I didn't quite completely grasp it. So it's just interesting to sort of see, how you've put it together just in slightly different scenarios, just so that we can understand it better. Because it's easy. I get bits of it, but I don't completely understand where the money's coming from, if you know what I mean.
Yeah. I've got one. The example I've got a bit of a template, but it's not quite right, and it's a bit tailored, so I probably can't share it straight away.
Data figures. I mean, I don't know whether there's something along. I mean, use the basis perhaps of what you've given us, but it's just, you said purchase a £200,000 commercial property, use 100,000 from your pension. Then I got a little bit lost as to the next bit of the process. So rather than trying to explain it to us all at this time of night, it was just whether or not it could be in a worked example on a document to refer back to.
I'll quite happily send some stuff over. That's not a problem. Yeah, absolutely. That's fine.
Great, thanks.
Brilliant. Thank you, Melinda. I've had another question.
When I go through the case study, it's no, sorry, it's not going to answer that question. But yeah, I'll get something over to you, Melinda. That's not a problem.
No problem. And what I can do, whatever you send over, Darren, I can send it out to all attendees if that's okay with you. Another question that's come through, Darren, does the pension work if you are buying buy-to-lets or just commercial property?
With pensions, it is only commercial property.
Okay. Yeah, that's it. That's all the questions that have pinged through at the moment. Thanks, Darren. Huggy, I think we're over to you.
Okay. Evening, everyone. First of all, thank you for having me along this evening. It's been a day for me. I've actually had a bit of positive news. It won't mean much to you, but I've been promoted in the course of today. So thank you. So usually I would be telling you that I'm a director of Foresight Group, but as of about 11:15, not that I was counting the minutes, I'm a partner in the business. So it's a very good day and ending on a high, clearly. So what I'm going to do, I'm going to share my screen with you. So if you just bear with me one sec. Hopefully you can all see that. So what I'm going to talk about are venture capital trusts. Going to focusing on them, and I do have 2 or 3 worked examples of how they might relate to people who own property, drawing income from property, indeed considering exiting property and concerned about the tax implications of all of those things. I'm going to move through them at a reasonable clip. I'm not planning to sprint through, but in the spirit of kind of keeping it flowing and energetic, I'm going to move through at a reasonable speed. But please do ask questions along the way. It is the sort of subject that the more you delve into it, the more there is to learn. I'm happy to answer any and every question that there might be along the way. So very quick overview of Foresight. I'm not going to spend too much time on this at all. It's hopefully one of the less interesting slides in the deck. All this is really trying to say is that Foresight are a large, well-established business. We manage almost £5 billion in assets. The vast majority of that is in infrastructure investment, although a substantial part is in private equity, and that's where the venture capital money that we manage would sit. As I say, there's a balance of infrastructure and private equity. We are about 80% infrastructure. So that would be everything from street lights to roads to solar panels, wind farms, and everything else. Private equity tends to be small commercial enterprises that we take stakes in. I've got a couple of examples of those, just so you've got an impression of the types of assets you would own if you were to invest into a VCT. So to begin with, I'm just going to give you a quick overview of where VCTs have come from historically, and indeed what the tax benefits are before we start to look at how you might take advantage of them as a property owner. The first thing to say is that VCTs are really well established. They've been in the market about 25 years now. And unlike some of the creative tax schemes that you might come across, these are government endorsed schemes. That is to say, the government are essentially trying to promote investment into small UK businesses from private individuals. And to do that, they offer tax benefits. So it's essentially the government and HMRC pulling a lever that says, look, we'd really like you to support this part of UK PLC. We'd like private individuals to take their capital and invest it in these businesses to help them grow. Therefore, if you do that, we'll give you associated tax benefits as an added sweetener. It does mean that you don't have to worry about being caught up in litigation with HMRC coming after you. You don't have to worry about your name hitting the newspapers. Anyone who saw the likes of Gary Barlow and others setting up as second-hand car dealers as some sort of tax scheme or whatever else. It's nothing of that ilk. Fundamentally, it is the government saying, it's not dissimilar to a pension in some senses. It's the government saying, here's how we'd like private investors to behave. One of the ways we can encourage them to do that is to offer tax benefits. And that's been around for about 25 years. The rules do change in terms of where HMRC are happy for you to invest, but fundamentally the basic schemes have been the same throughout that period. So quick overview of the tax benefits then. They are relatively straightforward, although there is a little bit of nuance to some of them. So I will expand where relevant. The first most prominent benefit and the reason that many investors invest in VCTs in the first place is that they offer 30% income tax relief. Now, there are a few things about that makes it especially appealing. The first is that is 30% regardless of your marginal tax rate. So if you're a basic rate taxpayer, you get 30%. If you're a higher rate taxpayer, you get 30%. If you're an additional rate taxpayer, you get 30%. It is on the gross value of your investment, so it doesn't matter what charges or fees you pay on your investment. Some of those will be offset by the tax relief because the tax relief is on the gross value. But what's really attractive about it, and certainly relative to other forms of income tax planning, is that it's available on income tax from any source. So whereas, and not to in any way decry or diminish pensions or other forms of tax planning that are very generous and appealing in their own right, the challenge with them is, as a landlord, be that residential or commercial, you can't offset the income tax associated with your rental income by using anything other than a VCT or an EIS. So it is an appealing way of reducing your tax bill, both from rental income, but also income from any source. So the way we describe it is both earned and unearned income. Typically, all you can reduce is your earned income. But with VCTs, as we'll focus on today, also with EIS, but we'll focus on VCTs today, you can offset income tax from any source. What that does mean is, Darren talked a little earlier about people potentially incorporating their property business and what happens when you come to take the income from that business. You're faced with the second layer of tax. You couldn't offset that second layer of tax using a pension or a number of other sources, because again, it would need to be, assuming you're taking that income as a dividend, that is, but you could offset it using a VCT. The only rule you need to be aware of is you must have paid tax in the first place. So the way it's often described is you need to think of it as an income tax reducer. So as long as you've paid the income tax in the first place, you can use a VCT to reduce that down to zero. You can't take it below zero, and the extent to which you're permitted more relief than you're able to claim, you would lose any additional relief. So to give you a very quick example of that, let's say, to keep the numbers simple, someone had paid £20,000 in income tax in a particular tax year, but they were to make a £100,000 VCT investment. In principle, they could offset £30,000 worth of income tax, but as there's only paid 20, they could just reduce that bill to zero. Outside of that, as I say, it's fairly straightforward, but the key thing is, and it will be particularly relevant when we come to some of our examples in a moment, 30% relief, regardless of the rate of income tax that you've paid, and it's on any income that you've earned or indeed unearned. Minimum term is 5 years. That is to say, to validate your relief, you need to hold your VCT investment for 5 years. Because of the structure of a VCT, you can pretty much hold it for that period and make an exit. So if one was to invest on the 6th of April 2020, on the 7th of April 2025, you could, in theory, exit from the VCT. I think we've had a couple of questions in.
Yeah, I was just going to interrupt you. Are you happy to read them off the chat, or would you like me to read them to you?
If I can work out how to read them off the chat.
No, that's fine. I'll do that for you. So the first
Okay.
one from Adam: are there rules around carry back and carry forward, or is it only in the TA year you are in?
Yeah. So for VCT,
Sorry, tax year. I've realised it was a mistake. I'm literally reading it verbatim. I do apologise.
No, it's fine. It's fine. For VCTs, you can only claim the income tax relief in the year in which you invest. For an EIS, it is more flexible. You can claim for the year in which you invest or the prior tax year. So for anyone who had an income tax bill that they'd like to reduce from the 1920 tax year, you could make an EIS investment and carry that back to that previous tax year to reduce that income tax bill. But for the VCTs, it's only in the current year.
Fabulous. And the next question, Adam, has that answered your question? If you can unmute yourself or just type yes in the chat box for me if that's answered your question, or if you need Huggy to follow on. Yes, perfect, thank you. Sean, I'll come to your question. Huggy, is the relief on investment into a VCT or the income generated from the VCT?
It's actually both, if I understand the question correctly. So if you look around the midpoint of the slide.
I don't know, Sean, would you like to unmute yourself and ask the question better than I have? No.
Hi, I was just wondering, use that example of £20,000 total income or income tax, and then you offset it with 30% of 100,000 that you generated. 100,000 put into a VCT. So is that income is that the money you've invested into the VCT, or the money that's come from generated from the VCT? If that makes sense. So do you get a 30% relief of the money into it, or the money that the VCT has generated as given to you?
So you actually get it. You get. Let me have a go at answering it, Sean, and then if I've not captured it, then come back to me. So with a VCT, what you get is when you make your initial investment, whatever the value of the check that you write, you will enjoy 30% income tax relief on that, as long as you've paid enough tax to claim it. But VCTs themselves generate an income, and that income is completely tax-free. What you can do if you don't need it is you can reinvest it and get another 30% relief. So most VCTs will yield an income of about 5%. So again, just keeping the numbers simple. Let's say someone invests £100,000 into a VCT. They're going to get £30,000 worth of income tax relief up front. The VCT then generates a 5% dividend, so £5,000. If you don't need that and you reinvest it into the VCT, you're going to get another £1,500 of income tax relief. Does that answer the question, Sean?
That does. Thank you very much.
Thank you.
Very clear. Thank you.
Sean. I've got another. Oh God, the questions are coming in thick and fast, Huggy. Okay, I've got another one from Stella. Stella, if I don't ask the question the way you need it to, please unmute yourself and follow on from me. The question is, for the minimum term 5 years, can the investor call back the money in case there's an urgent need within the 5 years?
They can, but they'd lose their tax reliefs. So any capital you drew back before the 5th anniversary, you would be liable to repay the income tax relief that you'd received. Where you do need to be a little bit careful with the reinvestment of dividends is what that can mean is you've got lots of little bits of money that you've built up year after year as you've reinvested your dividends. As long as you're withdrawing the money that has been invested 5 years, then you're fine, and you get a tax certificate and a share certificate to say this is when you bought the shares. So it is manageable, but it is just a thing to be conscious of. As one who has reinvested his dividends historically, it is a thing that you just need to take care with.
Fab. Has that answered your question, Stella? If you can just put a yes in the comments. If not, then please unmute yourself and ask a better question than I did. Yes, fantastic. Right, I just need to go back up because lots of questions have come in. Diraj asks, is the 5% guaranteed, please?
No, it's not. So this is an investment. Again, I'll give you a couple of examples of the types of companies you're investing into. But the way you can think of it is you own shares in the VCT, and just the same as if you own shares in Vodafone or BT or npower, whoever it might be, you can't, the dividend isn't guaranteed. You can't count on it. What we have seen historically is VCTs have generally paid a VCT of around that 5%, but in no way is it guaranteed.
Thank you. I hope that answers your question, Diraj. If not, let me know in the comment box and I will follow that up for you. So the next question coming through is from Adam. For a return of 5% per annum, I would expect this to be a low-level risk profile investment. However, the name Venture Capital Trust gives the impression it is high risk. Is this the tax dog wagging the investment tail?
It's a good question. I wouldn't say your return isn't necessarily 5%. That's your income yield. Your return could be significantly higher than that. So what you may well see is capital appreciation on your investment in addition to the dividend income. I think there is a very good point in at the heart of the question though, which is to say, or two good points actually. Firstly, that these are risk assets, these are risk investments, and again, I'll try and quantify that a little bit more in a few slides' time. And so it is really important that people understand the risk and are comfortable with it. And second, that while the tax reliefs are attractive, it is really important that we don't allow them to seduce us into the investment. Part of the reason they are there is to make the investment more appealing. That's why the government have put them in place. So while I don't think it's fair to say, well, look, your return is 5% and does that really work? Because your return could be significantly higher than that. I myself have enjoyed a single year return of 32% on a VCT I own. So the 5% is by no means a kind of best case scenario, but at the heart of the question are two really important points.
Fantastic. I think that answers the question for Adam. I've got another question coming that I've just lost. That was very careless of me. I do apologise. Which was, for a return of 5% per annum, I would expect this to, have I just, no, I've read that one.
That might have been, yeah.
Sorry, the next one. If cash is withdrawn, is there a taper relief within the 5 years?
No, it's binary. So you're either invested for 5 years and you benefit from the full reliefs, or you're not invested for 5 years and you lose the reliefs. There's no tapering.
Okay. Next question. How can we, this is from Stella, sorry. How can we know the VCT investment? Which organisation is monitoring VCT?
Can you run that by me again, sorry?
Stella, do you want to unmute yourself, my love, and just ask the question better than I did? All I've got on the chat is, how can we know the VCT investments? Which organisation is monitoring the VCT? I don't know whether that question is regards to regulation. Are VCTs regulated? Does anybody monitor what's going on? Is there an audit?
Yeah.
I'm just interrupting the question.
Yeah, sure. So there are a few answers to that, I think. So the first is all VCTs are listed on the London Stock Exchange. And so they are regulated in the same way as any company that you would see on the FTSE in that respect. They have to pass all the same rules of transparency. and submissions, accounts, and so on and so forth. Indeed, you could go onto Companies House and see the accounts there. You could open the Financial Times and see the share prices there. In terms of the first part of the question, my interpretation of that is, I believe, around how would one assess which VCT might be right, and getting an understanding of what's there and where they're invested and so on and so forth. My answer would candidly be to speak to someone like Darren. So while I represent Foresight Group, we run 3 VCTs. The marketplace has 54 VCT providers, most of which will run at least 2 or 3, some of whom will run significantly more than that. So in terms of the options in the VCT market, well into 3 figures. And I would say it's not for the layperson to try and make an assessment on their own and navigate this marketplace. I would definitely encourage people to seek financial advice, work with advisors who understand this market, how it operates, and they'll be able to give you a steer on the VCTs that work best for them.
I hope that answers your question, Stella, and I really hope that I interpreted that as it should have been. The next question comes from James Stewart. James, do you want to unmute yourself and ask the question, or are you happy for me to crack on as best I can? I'm going to crack on as best I can. So the first question is to Darren. If you could email the examples. Well, I've got James's email address, so I'll make sure that happens. Also, with the VCT, can I buy some land and build houses on it and then sell them?
That might be a pension question. It's more towards pensions.
Does somebody want to answer the question?
That goes more towards the pensions. The VCT is an investment, that Foresight will handle. But I mean, with pensions, you can use pension money to buy land. So you could do that. You wouldn't be able to build houses on it, but you would be able to build commercial units, something like that. So that's a possibility.
Okay, so the VCT.
What about normal houses? Could I build normal houses?
James, over to you. Sorry.
They would fall under domestic, not commercial. So a pension provider wouldn't allow it.
Even if I was building a lot of them and getting a lot of people to put their pension money into it.
Yeah, no, they're quite strict on it, because the pension would actually own the land, and what would happen is it'd be an unauthorised transaction, so the actual pension would suffer charges. So yeah, I mean, if you're looking at building, buying the land and building, a series of units, then I'm sure it'd be okay. What we'd have to do is sit down and ask the actual providers what they would accept. It's quite detailed and quite strict on what they will and won't accept. But as a rule of thumb, anything commercial is okay, but domestic not.
Okay, thank you.
No.
Great, thank you. Sorry to come over you again, Huggy. Just to follow on from that, Ronak's come in with a question. Could you not build houses and then sell them to invest into commercial? Sounds like we're trying to find a loophole here, I feel.
Again, I think that's more of a question for Darren and the pensions.
Yeah, I mean, do you want me to answer these ones, or just let Huggy play through, or do you just want to tackle them as they come?
Well, I suppose the questions are coming through, but I'm not sure which of you guys it really focuses on, because obviously if people have got VCT in their question, I'm assuming it's directly to Huggy, but obviously I then understand that it's probably a pension question. So I don't know. I mean, maybe the best thing to do is to let Huggy finish his presentation, and then I'll go back and we'll go through all the questions, and then keep adding your questions to the chat, guys, and then we can come back to the questions, and then Huggy and Darren can answer them together. If that's probably going to be easier flow for the meeting, if that's okay with everybody.
Yeah.
Totally fine for me. So just to pick up where I think we got to, we'd kind of covered the 5-year minimum term. The maximum investment in any one tax year is £200,000. Two things about this really. We do see a number of investments of that scale, but we also see a number significantly smaller. It says here the minimum investment's £3,000. That's ever slightly misleading in that technically there's no minimum investment. The minimum is whatever a provider would set it at. 3,000 is the lowest that I'm aware of. But actually, if a provider was willing to take £100 VCT investment, then there's legally nothing to stop you making an investment of that size. To give you a sense of what we commonly see, the average VCT investment is about £16,000. I'd say a common check size is anything from 10 to 50,000. And I make that point really to emphasize the fact that there are many who think that VCTs are the preserve of the super rich, of the very wealthy. You know, if you're a city banker who's just seen a 7-figure bonus, then you might invest in a VCT. Actually, the reality is very different, and commonly it's investors who are taking a small position as part of a broader portfolio, or indeed trying to tackle a particular tax problem that are investing in VCTs. And so that's why we see the range of investment. Last couple of benefits. Dividends we've talked a little bit about. So whatever the dividend the VCT yields, be that 5% or 32% or beyond, it is completely tax-free. And any growth that the VCT enjoys in addition to the dividends that it pays, that's also completely tax-free as well. So not to set unrealistic expectations, but if you invested in a VCT, it paid you all of your investment back in dividends over a 5-year period, and you doubled your money to boot, then when you made that exit would be completely tax-free. Now, again, I don't say that to set expectations. It's purely to illustrate the fact that as a tax-efficient vehicle, VCTs are very efficient. There are a handful of benefits they don't offer. You might wonder why they're on the slide if they're not offered by VCTs. It's because they are all benefits that are offered by EIS. I won't spend too much time on them, but just to give you the headlines. So if you make a capital gain, it's possible to defer the CGT associated with that gain through an EIS by simply reinvesting the gain. So to give you an example I'll return to shortly, let's say someone buys a property for £200,000, be that residential or commercial, sells it for £300,000, that person's made a £100,000 gain. What is possible to do is sell the property, put the £100,000 gain into an EIS and have no tax to pay, still enjoy the 30% income tax relief on that investment, and take the original principal of £200,000 and go away and do whatever you want with that £200,000. So it is a way of putting liquidity into assets that might otherwise stay as they are because there's a tax issue associated with them. EISs also offer IHT exemption and something that's called loss relief. That is a way of reducing the risk on the EIS. But again, as we're focused on VTTs, I won't spend too much time on that. So how do they work? I'm going to rattle through this a little bit because it's fairly straightforward, but it's just to illustrate. So an investor makes an investment into a VCT company, and what they actually own is shares in the VCT company. So I mentioned the VCT is listed on the London Stock Exchange. You should think of it as a company like any other. Just like when you invest in any other company, in return, you receive a number of shares for that investment. What then happens is the VCT will invest in a number of underlying investee companies, and it's from those that the VCT derives its value. So when someone invests in a VCT, a couple of things happen. Firstly, any companies that are already in the VCT, by dint of the fact that you now own shares in the VCT, you own shares, you own a stake in the underlying VCT companies. So anything that was already there when you purchased, effectively you own a share of that company as well. In that way, it's much more like other types of collective investment, by which I mean you can take a look inside a VCT, you can take a look at the underlying companies, take a look at what they're doing, how they're performing, and make an assessment of whether that's the sort of investment you would like to hold, or indeed if it's the sort of investment that you're not too encouraged by. So that's the first thing that happens. The next thing that happens whenever VCTs raise new money, they will typically use some of that to go away and purchase new investee companies and grow the portfolio, which again, as a shareholder in the VCT, you would also have exposure to and effectively own a stake of. It's probably ever so slightly out of sequence, this build here, but as I've said, you own a set of shares. You also get your income tax relief certificate. One of the things that's really nice about a VCT is that you will tend to get your tax certificate within just a few weeks of investing. That means that your relief is available very quickly and very often before your tax bill falls due. So if you are paying tax in January and July, for example, and you've made your VCT investment in February or March, then actually before that January payment falls due, you will have offset the tax. So from a cash flow perspective, it's quite appealing, it's quite attractive. Where EIS is a slightly less attractive is you're likely to have to pay your tax bill and reclaim it, whereas with the VCT, because you get your tax certificate so quickly, it's likely that you never have to pay the tax. I've mentioned the tax-free dividends. One of the things that is attractive, not so much at this time of year, truth be told, because we've just missed the boat, but the way VCTs work, most people invest in a VCT anything from October, November, right through to March, early April. And VCTs tend to pay a dividend in May. That means anyone who has invested in, let's say, February or March, will see a dividend payment typically within 2 or 3 months of having made their investment. So again, keeping the numbers simple, let's say I invest £100,000 into a VCT, I'm going to get £30,000 effective tax relief within just a few weeks of that. I've got my tax certificate back, and within a month or two, I might have seen an additional £5,000 of tax-free income. So within just a couple of months, I've seen a 35% return, if you'll allow me, from that investment. So in that respect, again, quite appealing. I won't spend too much time on this slide. Really, this is just illustrating some of the impact that VCTs have had. And really the story it's trying to tell is that they really are making an active contribution to UK PLC by supporting businesses, not just once, but typically through multiple rounds of funding, helping employ over 50,000 staff across the United Kingdom. This is why the government, this is why the Treasury continues to support VCTs and has done over 3 decades, because they really are making a tangible impact on the UK economy. So I'm going to come to some case studies now. These are the creative ways in which financial advisors and investors are taking advantage of VCTs every single day. The examples typically don't talk about landlords, don't talk about property owners. What I'm going to try and do is show you how some of them do directly address landlords and property owners. Some talk about other types of clients, but what I'll try and do is show you the parallels between the situation you might find yourself in and how these case studies are operating. please do fill the chat with questions. I suspect out of everything, this might be the area where the most questions come from. Julie, you're looking nervous. I can do some email responses if there are too many to get through. So the first one really does deal directly with landlords. And essentially what it's trying to talk about is the changes in rules around mortgage interest and the possible impact that that may have had on landlords and their income. And, you know, all of these examples are designed to be rather simplistic in the numbers, but hopefully the principles that sit beneath them are at least in part recognizable. What this is really trying to say is we have a client here who has a substantial property portfolio, but it's heavily financed, so about 75% financed across the portfolio. They have a 5% income yield. You guys will know better than I how modest or generous that is. And they have about a 4.5% mortgage payments with annual costs of £10,000 per annum. Now, what this first table is just trying to illustrate is historically, this landlord was making a small net income on that portfolio, having paid their costs and any tax that was due. But as the changes in mortgage finance started to come in the tax year 17-18, that small profit over time turned into a small loss. Now, as per Darren, it just so happens I own one or two properties myself. And while the changes haven't seen my portfolio driven into a loss, they have necessarily impacted the profitability of the portfolio. And all this example is really trying to say is actually it's possible to either offset the reduction in income that you've seen from the change in mortgage interest tax, or indeed for anyone who has seen, whether it's the portfolio or individual properties, dip into a loss, it is possible to use a VCT to offset that. And it comes back to a couple of things that I've mentioned before. So firstly, that you would enjoy 30% income tax relief, regardless of the marginal rate of tax that you're actually paying. Secondly, that because the rental income wouldn't otherwise be permissible to be offset, but with a VCT, you can offset income tax from any source, then actually you could use a VCT to reduce it. In this example, all we've tried to do is reduce the losses to zero. So you can see in the first tax year, there was a small investment of just £4,500 to reduce the £1,300 tax bill to zero. And in 2020-21, it was £10,000 to reduce the £3,000 bill to zero. So far so simple, but if you look forward just slightly on the slide, you'll see in 2024-25 a strange thing happens. Rather than investing £10,000, we invest just £5,600, and then from 2025-26 onwards, we don't invest anything, and yet we're reducing our annual tax bill to zero. That's because one of the really neat things about a VCT comes back to this minimum holding period I described of 5 years, where essentially the smart thing to do, if I'm not giving financial advice, but one would argue the smart thing to do at the end of your 5-year holding period is sell down your VCT, even if you don't need the money. Why do I say that? Because if you sell it down and reinvest it, you'll get another 30% income tax relief on that money. So at that stage, you've had 60% relief on the same capital, plus any dividends you've enjoyed along the way, plus any capital growth that you might have experienced in addition. So once you've made these investments for 5 years, it becomes self-financing. Because in year 6, you take the first VCT investment you did, sell it down, reinvest it. In year 7, you take the second VCT that you did, sell it down, reinvest it. And you do that on a rolling basis. So effectively, you've offset your tax in every single year without ever committing any new capital to it. The next example is relevant. So this is one that this is actually talking about a client who's realizing a share portfolio, but actually it can work in a similar sort of way for anyone who was looking at a property to sell down and has a capital gain on that property. One of the things we come across all the time are clients who are put off of liquidating their assets because of the tax bill associated with doing that. And where there's an opportunity, there have been some changes to EIS recently. So I mentioned before that what you could do is you could take just those gains, invest them in an EIS and defer the capital gain. And that's absolutely fine. It works perfectly well. The challenge is now that because the rules have changed slightly around EIS, it will take a little bit longer to deploy the money. So whereas a VCT is a qualifying structure in its own right, when you buy shares in the VCT, you've made your qualifying investment. With an EIS, that's not how it works. The capital drips into qualifying companies, and it's only when you've invested in those qualifying companies that you get your relief. That does mean that it can take 18 months to 2 years to deploy EIS money. What it also means is when you come to exit at the other end, you're going to have to exit as and when the manager exits those companies, and that itself could take several years to do. So there's far less liquidity, there's slower deployment and less liquidity in an EIS. Still appealing if you're able to accept those compromises, but that has led some to seek an alternative solution. And simply in this example, what we're trying to argue is, if you're prepared to ignore that one is CGT and one is income tax and just think of it as tax, if you're anything like me, when you pay your tax bill, you're not thinking, well, that's for national insurance and that's for income tax and that's for CGT and that's for, all you're thinking is, I've got to write a check to the tax man. As long as you're prepared to A, look at it this way for this particular scenario, and B, you have enough income tax to match your CGT bill, then there is an interesting opportunity. And that is to invest in a VCT rather than an EIS, and to use the income tax relief to offset the CGT bill. Now, just to talk you through this example, and keep in mind that this is an example based on 20%. Clearly for a property sale, you're looking at either 18% or 28%, but the premise is the same. So in this example, the client has realized a gain of £125,000 that's given rise to a CGT bill of £25,000. So in this example, 20%. What the client can do is take a proportion of that gain, in this example, £83,000, and invest that in a VCT. That would give them £25,000 worth of income tax relief. So what they can do is take the income tax relief and effectively net off against the CGT bill. So they've exited that investment in a way that is tax neutral. In this example, we've actually focused on the amount of gain that's released. So in this example, it says there is just shy of £42,000 worth of gain that's liquidated that they could take off and do whatever they wanted with. But what it ignores is the original investment. So again, if we kind of put this back in the language we used earlier, let's say you've made a £200,000 investment into a property. You've made a £100,000 gain on that, and now you wish to liquidate. If you were an 18% taxpayer for CGT purposes, then in that instance, you'd be looking at investing around £60,000. So you would have actually made available to yourself £240,000 for other investment or to do with whatever you wish. And you've had to tie up, in that example, £60,000. If you're a 28% taxpayer for CGT purposes, then you are going to be investing just shy of that £100,000 gain. So you are going to have to put all of the gain in, but you've still freed up your original investment into that property to go away and do with what you like. So we are seeing this increasingly commonly, because again, once your 5th anniversary is up, well, 2 things. First of all, you would typically enjoy tax-free dividends for the 5-year period until exit. And on the 5th anniversary, you can exit. In this example, there would be 83,000 to withdraw. In the example we were just talking about, subject to investment performance, of course, 100,000 or thereabouts to withdraw. And actually, you've exited your property effectively tax neutral. I like to think of Rishi Sunak giving you a check, and you're giving Rishi Sunak that check back, saying, "Thanks very much, that's your CGT bill paid." Let Rishi pay himself, I say. So this next example is about generating a tax-free income, and again, it focuses on pensions. It works perfectly well for pensions, but again, it works just as well if you're looking at making the income from your property portfolio tax neutral. And it's fairly straightforward. So if you ignore the big numbers at the top and just focus on the £30,000 of income, let's call it £30,000 of rental income. And in this example, we're saying that the client, as a result, has, if that was their only income, they'd have a tax bill of £3,630 to pay. What that client could do is they could invest £12,100 in that same tax year. That would give them relief of £3,630. Therefore, their income in that year is tax neutral. If the client was to do that every year for 5 years, they're then back in the scenario we described before, where you could encash and reinvest your VCT investment from year 6. From year 1 and reinvest in year 6, from year 2, reinvest in year 7. Therefore, not only have you given yourself a completely tax-free income, but you would also benefit from tax-free dividends that effectively gives a pay rise of about 25%, because you're going to pick up, in this example, an extra £3,000 or so of tax-free dividends, and you've saved £3,600 of income tax. So net, you would be up £6,500 of income each year, for the cost of having invested about £60,000 in VCTs over a 5-year period. And as I say, once you've done that, you move into a rolling investment. The final example, I've kind of talked about this a few times, so I suspect I won't need to dwell on it in particular, but it really is just to drive home the power of this recycling point. I did my first VCTs literally 5 years and 2 months ago, and I maybe shouldn't show you the provider because it is a competitor, but this is my form to encash my VCT and roll that over into new investment, because while it's performed perfectly well, this is the VCT that did give me a 32% dividend in a single year. So I'm really happy with the performance of it, but actually I can get another 30% relief on that money, plus any dividends going into the future. And so as a personal choice, I kind of think it's a no-brainer. Despite my lofty position now after today's promotion, it'll be some time before I'm able to retire. I think the promotion comes with new business cards, but not much else from what I can tell so far. And so for me, you know, I'm looking to roll my VCTs at least 2 or 3 times before I'm ready to call it a day. And so I would expect to enjoy, certainly on the VCTs I've done in the first few years, around 90% income tax relief on those before I'm done. And that really is, for me, one of the most appealing things about VCTs. I forget who it was, apologies, but someone very, very rightly raised the risk point earlier. The thing to really understand with VCTs and make sure that you're comfortable with and can tolerate is the associated risk. There is a reason why the government gives tax relief around these investments, where they don't give the same sort of tax relief around something like an ISA, for example. And it is in no small part the risk of the underlying companies that you're investing in. That said, there is a range of risk within VCTs. One of the misconceptions is that all VCTs are made the same. And I think as soon as people hear the name venture capital, that conjures certain thoughts that may or may not be appropriate. So I just wanted to give you a couple of examples of the types of investments that you might see. This isn't intended as a product plug. It's really just to show you two of the different flavors of VCT that we have. And I'm going to talk about the different types of investments that sit underneath them. And hopefully you'll see as a result of that why I say there is different risk inside VCTs depending on where you invest. The first I'll talk about is a company called Mowgli Street Food. I'm not sure where you guys are based around the country, but there are Mowgli restaurants in Nottingham, Leicester, Liverpool, Manchester, Leeds, Oxford. I think there's one certainly one in Birmingham, and I think there might be one opening up in Newcastle. And the way I often find easiest to explain the difference between VCT investments is you get investments that are post-revenue, post-profit, by which I mean these are companies who are relatively established, they're making profit, and what you're trying to do is replicate that model in different locations around the country. And that's what we're doing with Mowgli. So this is a business that was originally started up in the Northwest. There were a couple in Manchester and one restaurant in Liverpool. It was post-revenue, post-profit, so it was making money, doing rather well. But the founder wanted to open new locations around the country. And as you would have guessed by the description I've just given you, we invested into the business to allow them to do that. And essentially, it's almost like taking a potato print and just replicating that model around the UK. Now, that's not to say there isn't risk associated. That's not to say that these companies don't find themselves in trouble from time to time. But the principle of it is more conservative in its risk profile, in that you're taking something that you know works and you're just trying to replicate it in different cities around the UK. If you compare that to something like Open Bionics, without giving you the full spiel on Open Bionics, what this team are doing is they've created a 3D printable bionic arm. And it's difficult to cover this without giving you the whole backstory, but essentially, unless you are very well insured or very wealthy, certainly as a child and very often as an adult, it's almost impossible to obtain a bionic limb, by which I mean a functioning arm that you can use, as opposed to a rubber prosthetic. They are incredibly expensive to the extent that as an adult, at best you could hope for is a very long waiting list with the NHS. As a child who's growing relatively quickly and would need a change of arm every 6 months or so, you simply wouldn't be allowed to have one. They cost anything from £30,000 to £40,000. But because Open Bionics have worked out a way to 3D print these arms, they can actually produce them for £5,000 to £10,000. That brings them into scope for insurance companies, brings them into scope for the NHS, and indeed they are the only firm who have a contract with the NHS to provide bionic arms for children. Now, this is a business that when we first saw them, they were post-revenue, so they had made a few commercial sales, but they were pre-profit. Very often we'll invest in these businesses when they're pre-revenue. So they've made no commercial sales. The only income they might have might be a government grant or something like that. But in terms of commercial revenues, very often they don't even have a completed product yet. And that's why I say there is a real distinction in risk. It's not to suggest that there's no risk in the Mowgli model. It's just to say there's significantly more risk when you're investing in a company that isn't making profit, perhaps isn't even making revenue, doesn't have a product in the marketplace yet. When you're making an investment into that business, there's much more that can go wrong, and we see that reflected in the failure rate. So the failure rate in F1, which is where you'd find things like Mowgli, is about 1 in 10 businesses. So we definitely see failures, but it's about 10% of the portfolio. That doesn't mean that everything else makes profit. Some of them will lose money, but in terms of failures, it's about 1 in 10. In this, the Forsyth Williams proposition, it's a little too early to say because it's actually quite a young proposition. But in the marketplace, you expect 50% of the companies you invest in to fail. Now, your compromise is in F1, your return is maybe 3 times capital you'd expect. In fact, our average exit rate for companies is 3 times cash. In something like Forsyth Williams and in the true kind of venture end of the market, you'd expect your winners to return about 10 times cash. So you'd see far more losers, far more companies that fail in the true venture end of the market, but your winners would be much bigger. In what we call the private equity end of the market, you would see fewer failures, but your wins would be much smaller. And that's a compromise. So I can't stress enough, both carry risk, and it's really important that people understand the risk and are comfortable with it. But there is a range. It's not all one size fits all. In terms of my slides, that's it. I don't know if you want to do my questions now, Julie, or if you want to wait till the end. It's up to you.
Sorry, I couldn't even unmute myself then. That's how talented I am. Thank you so much for that. I mean, the comments that are coming through, apart from the ones that I've already looked through, which is just, oh my God, this is so informative. Thank you so much for this. This is amazing. I mean, we've got so many positive comments coming through. Just your last, I'm not quite sure which it was, the second slide or the last slide from the end. Open Bionics, is that the one?
Yeah.
Yeah. That's really hit home with me, actually. That's quite resonant because nobody else on this forum knows this, so this is an exclusive, people. I actually work for the UK's only fully paralysed motorcycle racing team, and basically we work with anyone that's paralysed from the chest down, and we also work with other people that have had motorbike accidents that want to race again. And one of my racers, Louis, lost his leg from the hip bone. He's still got his hip bone. That's all perfectly fine. Everything from the hip bone down on the right hand side gone. And he's had to go to America to actually get his prosthetic leg manufactured to his needs for racing. And it's quite funny because on Instagram he's actually known as One Leg Louis, which is quite funny. But just to see that somebody has tailored that kind of instrument and seen that that's what's needed, I mean, just wow is all I can say, and I'm taking that back to the team tonight.
Please do. I mean, Open Bionics, if you haven't seen them in the press already, you will see them a lot. They really are making huge waves. If you look at the image, you'll notice that this arm bears a striking resemblance to the Iron Man arm, and there is actually a little Iron Man
the logo,
the elbow, and the principle of it is it's trying to turn disabilities into superpowers. Is kind of the tagline, and it's really trying to address the fact that if you're a small child who probably feels very self-conscious about the fact that your body isn't the same as all of your friends and all of your schoolmates, it can be a really difficult and challenging thing to have to go through. And they've partnered with Marvel, they've partnered with Lucasfilm, and so there are kind of Star Wars arms and so on and so forth. And just as a story, it's a really great thing they're doing. As an investment, it's got lots to commend it, but actually just in principle, what they're doing really is something quite special. So
yeah, I think that's absolutely phenomenal, and yeah, it's one of those, you know, we were sitting there talking about investments, and then suddenly that came up and it was like, oh my God. And now investment's gone right out of my head. So I'm going to try and get back in the room and go through the questions. So we've got loads of questions that have come in. So I'm going to go through them. So Darren, if you can unmute yourself as well, because I think it's going to be a bit of a tag team here on the questions, because genuinely, I'm not sure which apply to either of you, if that's okay.
Yeah.
So I'm going to see if I can find where we came in. Okay, so Adam asked, I was told you could build houses, but you would need to sell them before they had kitchens and bathrooms, etc. They are not residential until they can be lived in. Is this correct?
I assume not. No, I'm sure the developer's not going to stop and we've hold a kitchen. I think what would happen is the pension company would look at the underlying investment, which is a residential property, and wouldn't allow it. One thing, probably what I didn't point out is, this isn't saying you only have to invest in commercial. There's lots of strategies we can use. You can have your investment portfolio at the moment and use that to extract profit to put in a pension, or at some point switch your attention and get one commercial property, and then down the line we can use your pension each year to extract money, and then down the line we've built up both. We've got commercial property, we've got pension, and then we can do it. There is lots of ways to do it, even with the VCTs, and that's kind of the point of tonight. There's lots of strategies we can use, and it is all sort of circumstantial. But little things like not putting a kitchen in, the companies are going to look at and they won't allow. But if you're trying to think of tips and tricks and ways to get around things, then I've probably been through like 95% of them, or thought of them myself, and asked the question. So I know the ones that will work, and if we can put them all together, pensions, VCTs, all the other investments, all your property investments, then we can make you as tax efficient as possible.
Fantastic, thank you. A question from Ronak. Do VCT investments at seed capital, Series A, B, etc., trying to assess risk? Ronak, if you want to unmute yourself, because I'm sure I haven't delivered that question as well as I could have done.
Yeah, so I was just trying to ascertain where VCTs invest in the company cycle, i.e. early stage. Is it seed capital, Series A, Series B funding, etc.? So I think you've covered that in terms of later on in your presentation, in terms of pre-money, pre-revenue, etc.
Yeah. It sounds like you picked it up, Ronak, but it could be anywhere in that cycle. It could certainly be Series A. Different VCTs depending on their focus. So if they were focused on that pre-revenue, pre-profit, or post-revenue, post-profit, they would invest at different stages.
So you're looking at sort of pre-money. Ideally, you're looking at sort of pre-money evaluation, trying to get in there early to capitalise on the value effectively.
Again, that would come down to your appetite for risk. So as I said in the Open Bionics example, so we have a VCT, effectively a technology VCT, and what that's trying to do is get in as early as possible for the benefit of enjoying massive upside. That will see a proportion of failures, and a larger proportion than the other VCT we run, which is really trying to get in as late as it can, when these companies are established, fairly robust, and we can have a good deal of confidence that if we just replicate their model around the country, then that's how they'll enjoy growth. So it down to, go on, sorry.
Sorry, I was going to say, but then I suppose the valuation then goes up if you try and get in as late as possible.
Oh yeah, for sure, and that's why your return is lower. So for me, it's the point I was trying to make with that is it depends on the investor's appetite for risk, and it's one of the things to think about before investing. So if for example one's priority was, look, I want to minimize risk and just enjoy these tax benefits, then one might look more towards the later stage VCTs, where you knew you weren't going to see a really large upside, or you wouldn't expect a large upside from the investments, but nor would you expect to see failures along the way. Alternatively, if one thought, actually, this is money that I can afford to put at risk to a greater degree, and what I really want to do is see some really exciting returns, then you'd go more towards a technology VCT. Just for reference, I've done both, because there's part of my money that I'm willing to put at a greater risk, and there's part of my money that I wish to be slightly more conservative with. So it's certainly possible to blend those two positions, but you will find VCTs that invest right across the range.
So basically, to look at it would be to say, if I've got a tax bill of X that I've got to pay, either I pay it to the taxman or I take a risk and put it into a VCT. And worst case, if it does get written off, then it's money you would have paid to the taxman anyway.
Yeah, but keep in mind that you're only getting 30% relief on your gross investment.
Yeah, I appreciate that. Yeah.
So if your bill to the taxman was £10,000, you wouldn't be offsetting 10,000 by putting that into a VCT. You'd have to put
3,000 would be the offset effectively on that. Yeah.
Yeah.
Thank you.
Thank you.
I appreciate that. I'm going to move on to the next question. Again, exactly the same format. I'm going to read the question out, which is from Adam. And if I don't get the question verbalized correctly, then please, Adam, unmute yourself and correct me. The question is, can we know the certainty that we could have an ethical investment in a VCT? On day one, we know who the investment, but we do not know future investment strategies.
Yeah, so there are ethical VCT providers out there, and the way you can get confidence, you're absolutely right. You can know the investments that exist today and that you're buying into on the day that you invest, but by definition, you can't in future. I would say that is true of any ethical manager that is still actively purchasing new companies and new shares. But where you would find comfort is in the mandate of the VCT. So they will have a prospectus and they'll have a mandate that says this is where we will invest, and if ethical or socially responsible or ESG was something that was important, you'd really want to take a look at that mandate, and candidly, unless they change the prospectus, at which point they have to write to investors and let them all know that that's what they're doing, then they have to operate within that mandate. You only get the license from the FCA based on the mandate that you say you're going to operate inside, and they set parameters that mean you can't just stray outside it.
Adam, I hope that's answered your question. If not, please pop it in the chat or unmute yourself.
I'll answer my question. Things, for example, if I don't want to invest in anything packaging, for example, yeah, like, you know.
Adam, I can hardly hear you, my love.
Can you hear me now?
Try again.
A bit better.
Yeah. So if I want to avoid things like packaging, yeah, is that something we could avoid? But with all the environmental issues that are associated with it at the moment, yeah, it's not mainstream, but it's the sort of thing I just wouldn't want to get involved in.
Yeah, for sure. Again, you'd have to have a look at the mandate and the parameters of the individual VCT. So for example, there would be nothing in either of our VCT. There's nothing that is packaging in either our VCTs. But I couldn't say to you, don't worry, there'll never be packaging in there, because there's nothing in our mandate that says we wouldn't do it. So you'd have to look for a manager that had those environmental, of which they certainly exist, that had those environmental components in their investment mandate, where they say, look, we will only invest in companies that either are doing this or aren't doing that. They call it a negative screen, where so we have negative screens on some of our other funds, just not on this, where we will literally say that we'll only invest in companies that are making an active contribution in these areas. So not only not doing any harm, but making a positive contribution, and things like they're signed up to the UN Global Compact, signed up to the Principles for Responsible Investing, and so on and so forth. So they're certainly out there, Adam. It would be about, and I'd encourage you to go through an advisor to find them, because, as I say, I think you'd be looking through something in the order of 200 individual VCTs if you were to try and do it yourself. But you're looking for a manager who has a mandate that says, this is how we operate, and that means that it's outside of our mandate to invest in this sort of company, e.g. packaging.
Okay, that's great. Thank you very much.
Thanks.
Thank you, Adam. I'm going to move on to the next question from Chen. Again, the same situation. If I don't verbalise your question correctly, please unmute yourself. The question is, can I invest in a VCT and then get the VCT to invest in a company that invests in the properties?
No.
What you can do, you could use your pension as a way to extract money, and then you could use that to invest in property. Again, it has to be commercial, but you could use your pension as a tool to siphon off money with a longer term plan that we then use that to buy property. So that can be in the form of a deposit. Again, if you already hold some kind of commercial property, then you're just buying it off yourself, and you're just freeing up the money to cycle. So that can become really efficient.
On the VCT front, it wouldn't be possible to influence the manager to invest in any company that you wanted them to. They will have their mandate, and they'll invest in the companies that they feel are most appropriate. They wouldn't be influenced by an individual investor.
Again, the same situation applies. As I ask these questions, when I mention your name, if I don't ask the questions correctly, please unmute yourselves and correct me. I'm going to move on to the next question from Ronak. What is the average % of companies that fail?
As I say, it definitely depends which end of the VCT market you're looking at. So in the private equity market, it's about 10%, 1 in 10. In the venture capital end of the market, as we would describe it, so they're all venture capital trusts, but we would say private equity is the post-revenue, post-profit. Venture capital is the pre-revenue, pre-profit. And in that end of the market, the average failure rate is 50%.
Okay. I'm going to move on to a question from someone who, from what I can see from the screen, has unfortunately left us before you can answer the question. The lady Elaine. She apologises in advance for being a novice, but that's the whole reason why I put these on, is so people can learn. It's not about being a novice, it's about learning. And her question is, you seem to imply your property portfolio can be linked to the VCT, or would it only be paid over cash investment? This webinar is so intriguing. Oh, intriguing. That's a new word. Intriguing. Sorry. As I'm saying, I'm literally reading them without reading them first. Sorry.
Yeah. So apologies if I've created a sense that the VCT would only accept cash. So where I think that I might have created some confusion was, for example, when I was talking about if you'd invested in a property and you'd seen some gains, ultimately what you'd have to do is realise those gains and invest cash into the VCT. So fundamentally, you are either writing a cheque or sending an electronic transfer to the VCT provider. That's the only way you can put capital into them. They won't do a share exchange, that they wouldn't accept property deeds or anything else like that. You ultimately need cash to invest with them.
Okay,
I think
I'm hoping that answers the question. Like I say, unfortunately,
what I was just going to say, Julie, is it's not directly linked, but they are great tools to use for the problems caused by property. Same with pensions. You know, there's kind of many other tools at our disposal, financial advisors, and it's just finding that right tool for that right problem. But like I said, the two we've tried to talk about tonight have got really good advantages. So, yeah, VZT's not directly with the pension portfolio. Pensions are, but again, both used in an overall strategy work really well.
I mean, I have a question. It's a personal question, so I'm not sure where this is really coming from. A very good friend of mine. It's not one of those. It's for a friend. It really is a very good friend of mine. Is looking to buy her first home. She's only 34. She has a very good job as a manager of a citizens advice bureau, and she has not a bad credit rating, because although she spends on her credit cards hard, she does pay them off every month. Can she use the pension that she's managed to create in industry to purchase a property? And that is a property for her to live in. That's her dream, to live in that property, not a property to rent out.
No.
No, that's it. No.
Sorry to dash her dream. No.
I like a blunt answer.
No, she can't. No, if she's, look down the line, she's bought that property, she's now, she's got excess money, she's built up, she might look to go to buy a buy-to-let. Now, all the changes, like we said, she could put that into a company, or she's going to get charged heavily on stamp duty and whatnot, doing it personally. But what she might want to do is look to buy a commercial property where she's not going to be impacted as hard, and then what she can do is use that pension money to almost buy a commercial property at a lot faster rate. To essentially be able to set up a company, buy the commercial property within that, use her pension money to buy a proportion, and what essentially she's done is freed up the money from a pension into the business. Rather than leave that in the business to suffer corporation tax, she's probably got a big annual allowance that we can use, even go back 3 years, and just put the money straight back into a pension. Now, it stops her paying a corporation tax, the money's back in a pension, and she can go again. And what we can do is look at the rate, look at how much annual allowance she's got, and then use that to buy, say, 40,000 a year, and just play with it, that she's not using one to create another tax bill. So really tailor it to what she needs.
Yeah, I'm just going to add in, because there's obviously only a few of us left in the room now, and I have seen the reasons why people have needed to leave. So it's not you guys at all. It's personal circumstance and other things. We are now a smaller group. Adam, you've made a very good point to the comment I've just made. Are you happy to unmute yourself and verbalise that, or shall I just read that off the comments?
Yeah, I mean, can you hear me?
Yeah, absolutely.
Yeah, I mean, I'm led to believe that at the age of 55, you can take out 25% of your pension fund tax-free.
Yeah.
Yeah. So, if you want to wait 20 years to get on the pension, on the tax-free, ladder, she can wait, yeah? Yeah. Might not be that practical for her, but, if she's working today and she's earning cash, she's not going to be putting 40,000 into a pension scheme if she's trying to buy a house. Yeah.
No, and this is like I said, it's all circumstantial. So some people have portfolios, some people investing in properties secondary to their business. So this is again a way that them guys can almost use that to extract money, build up the pension pot, and you don't need to wait till 55 to actually purchase any property. Yes, you would get a 25% at 55, but then again, the VCTs can come in. You know, you're looking at smaller investments, and you do that. Say you start out at 50, then when you hit 55, you can take, you know, the rest of your money tax free. So that's what we do. We just play around with people's individual circumstances. No way we are saying that everybody's got 40,000 to put in a pension every year. We work with what people have got.
And I thank you for your comment, Adam, because to be honest, I hadn't actually triggered even in my head about the 55-year limit, to be fair. So I really appreciate you putting that forward. And like I say, I am speaking on someone else's behalf when I ask these questions, but I am quite aware that she's not probably the only person in that situation. So this kind of may answer someone else's question as well when I'm asking it. We've had someone else join the group back, Stella. Hi, have you got some more questions for us, Stella? Because I know you were quite active in the questions to start with. Okay. No? James, have you got anything to add with us? You need to unmute yourself, my love. Or do I need to unmute you? Oh, good Lord.
Here we go.
Charge. You should be unmuted, James.
I am unmuted, I think, yeah. Just getting back to this, I'm over 55, so, and I don't pay a lot into pension, but I've got a company that I bought a block of property with, and it's split into two parts, an HMO and a shop. Would that count as, how could I have arranged my pension so as effectively pay my from a company into the pension and give the money back to the company? Can you do that?
Sorry, could you repeat that?
I'm just looking at, in a VCT, could I set up a VCT for the whole block? It's got an HMO in the top part and it's got a shop in the bottom part.
No, what you could do, you could use some pension money to buy the shop.
The shop, yeah.
They wouldn't take the HMO part, so essentially the pension would own the shop.
The shop.
Yeah, and the business would still own the HMO.
Okay, that may be a possibility. Thank you.
No worries. Julia, are you going to pass my details around?
I don't know. Have you been good enough?
all I was going to say, if anyone wants to get in contact and talk about individual circumstances.
Hang on, love. I've got another question in the chat box. Hang on. Chen, do you want to unmute yourself, or are you quite happy for me to verbalise your comment? I'm going to go for it. At Darren, can you use pension money to buy commercial property to convert to resi and then refinance to pay the money back into pension? Wow.
No, I think it falls down in the first part. You couldn't.
I love the fact you just go, no.
I've tried. I mentioned there was two people that have really helped me out a lot. Huggy's one with all the information on VCTs, but there's a guy from one of our SIP provider, and he has me on the phone probably 3 times a week asking him, well, what about this? And no, so you wouldn't be able to. What would happen is a pension company would own the property, so you couldn't turn it into residential because they're just not allowed to hold it. So, no, unfortunately not.